investment property for a big gain. Congratulations. Now the IRS wants its cut, and that cut can swallow a quarter to a third of your profit. But what if you could pay zero on that sale? Not avoid it. Defer it legally, indefinitely, and put every dollar of your equity to work in the next building. That is the 1031 exchange. It is the single most powerful wealth building tool in the entire tax code, and most sellers leave it on the table. In the next few minutes, I will show you exactly how it works, the two deadlines you cannot miss, and the mistakes that blow the whole thing up. Let's go. Here is why this matters. Sell a property the normal way, and you get hit from three directions: federal capital gains, depreciation recapture at 25%, and the net investment income tax. Stack those up, and you can hand over a quarter to a third of your entire gain. On a $1 million gain, that is $250,000 to $500,000 gone. A 1031 exchange defers all of it. Instead of reinvesting what is left after taxes, you reinvest the whole thing. That is more equity in a bigger deal, compounding for you instead of for the government. So let's break down how it actually works. Start with the core idea. A 1031 exchange, named for Section 1031 of the tax code, lets you sell investment or business real estate and reinvest the proceeds into more real estate without paying capital gains tax on the sale. The key word is defer. You are not erasing the tax. You are pushing it down the road. And you can keep pushing it, exchange after exchange, for decades. Hold that final property until you pass it on, and the gain can be wiped out entirely for your heirs. Investors call it swap till you drop. It is how serious operators compound wealth tax-free. Now the rule that trips people up the most. Like kind. It sounds restrictive. It is not. Like kind simply means real estate held for investment or business, swapped for other real estate held for investment or business. That is it. You can sell an apartment building and buy a warehouse. Trade raw land for a retail center. Roll an office into industrial. They all qualify. A very popular move right now is exchanging a management heavy property into a passive triple net deal. An NNN building, where a national tenant pays the rent and the expenses, and you just collect the check. What does not qualify? Your personal home, a vacation house, or property you flip as inventory. Those are out. This is the part nobody can skip. The 1031 runs on two clocks, and both start the day your sale closes. Clock 1. You have 45 days to identify your replacement property, in writing, signed, delivered to your intermediary. Clock 2. You have 180 days to actually close on it. And here's the brutal part. These are hard stops. No extensions for weekends. No extensions for holidays. No! The financing fell through. Miss either deadline by a single day, and the entire exchange fails. The tax comes due. So the pros: line up replacement properties before they ever sell. Do not start the clock without a plan. Here is the rule that quietly kills more exchanges than any other. You cannot touch the money. When your sale closes, the proceeds do not go to your bank account. They go to a qualified intermediary, the QI, an independent third party who holds the funds and then uses them to buy your replacement property. If that cash ever lands in your hands, even for a day, the IRS treats it as a taxable sale, and the exchange is dead on arrival. So you set up the QI before you close, not after. And it has to be independent. Your own CPA, your attorney, a business partner, none of them can serve as your QI. Pick an experienced, bonded, well-capitalized intermediary, because they are literally holding all your money. Now the fine print that catches people. First, to defer the entire gain, you have to buy equal or greater, both in value and in debt. Trade down, and the difference is taxable. Second, identification. The simplest path is the 3-property rule. You can name up to 3 replacement properties of any value, and most investors name 3, so they have backups if a deal falls apart. And third, boot. Boot is anything you walk away with that is not like-kind real estate. pull cash out, or take on less debt than you had, and that difference becomes taxable boot. The fix is simple. Reinvest all of your proceeds, match or exceed your old debt, and keep your hands off the cash. Let me burn two numbers into your memory, 45 and 180. 45 days from the day you close your sale to identify your replacement property, in writing, 180 days to close on it. These two deadlines run at the same time. They start the moment your sale records, and they do not move for weekends, holidays, or bad luck. Every successful 1031 exchange lives or dies by these numbers. Mark them on the calendar the day you sell. Now, the mistake that wrecks exchanges over and over, treating the 1031 as an afterthought. Two ways it happens. One, you let the sale proceeds hit your account thinking you will reinvest them next month. The second, that money touches your hands, the exchange is dead, and the full tax is due. Two, you close the sale with no replacement property in sight, and then the 45-day clock runs out while you are still shopping. Both are fatal, and both are completely avoidable. Engage your QI and identify your targets before you ever close. A 1031 is not something you figure out afterward. It is something you set up in advance. Let's lock it in. A 1031 exchange defers your capital gains tax when you reinvest into like-kind real estate. And like-kind is broad, so you can sell an apartment and buy a warehouse or a passive NNN deal. Remember the two clocks, 45 days to identify, 180 days to close. Both hard deadlines with no extensions. A qualified intermediary has to hold the money, touch it yourself, and the deal is dead. And buy equal or greater in value and debt, or you create taxable boot. Plan it before you sell, every time. If you are sitting on a property with a big gain, do not let the tax decide your next move for you. I am Ryan Solberg with MaxLife Commercial. We help investors structure 1031 exchanges and find replacement deals across Central Florida and the entire state. Run a replacement property through our free 1031 deal analyzer at maxlifedevelopment.com or call us directly at 321-586-2121. Let's keep your equity working for you instead of the IRS. I will see you in the next one.